Hi everyone, this is Gary, and what we're going to do today is we're going to be taking a look at the problems that you're assigned in week 2, and that is problem P2-29 and CP2-41. Now, the CP2-41, don't be confused by this, it's actually P2-41, but in the textbook, you'll notice that it sits under the heading called Continuing Problem. And again, this is a problem that we're going to be looking at throughout these 7 weeks, doing different functions within the same set of data. Okay, so let's first start with P2-29. And in this problem, we're discussing Vincent Yarwood, who practices medicine, and there are certain transactions that have taken place from July 1st through July 31st. Now, last week, when in your assignment, what you did was you looked at the effect of transactions. In other words, we looked at a particular transaction that took place in a business and we determined whether it increased or whether it decreased a particular account. Now, this week, what you will have done is in the chapter, you will have read about debits and credits, because when we are increasing or decreasing an account, we're going to be either debiting that account or crediting that account. Now, I also posted in the discussion forum a video about debits and credits, and I want to make sure that you do view that video because it's important that you understand what a debit and what a credit is, because that is the foundational concept that you'll need to know going forward. The one thing that I would definitely recommend is get the idea, the terminology out of your mind that you might already have. For instance, most of us think of debit as a debit card where we take money out of our account. So we tend to think that debits would decrease an account. Sometimes that is true, but in accounting, debit and credit means a much different definition. What it basically means in accounting, debit just means left and credit means right. And that is in terms of the T account that we're going to be looking at, whether you're going to be placing it on the left side or the right side. And that depends on whether it's an asset or a liability or an owner's equity account. So again, take a look at the video where the instructor goes over in much more depth about debits and credits, and also make sure that you understand it from reading chapter 2 in the textbook. Okay, so in this particular week, what we're going to be doing is we're going to be taking a look at the transactions, and we're actually going to be doing in the first requirement here journal entries. And in every journal entry, your debits must always equal your credits. So for every transaction that occurs within this business, we're going to be debiting an account or crediting an account. And they always must be equal to each other. So in some instances, you may be debiting one account and crediting two accounts. But nonetheless, those debits must always equal the credits. So I can't emphasize that enough. Debits must always equal credits for every single transaction. So what we have here in the first requirement is we're going to have different transactions that occur. And what you need to do is take a look at that transaction and you determine, okay, what account are we debiting and what account are we crediting? When you determine that, you're going to be choosing from this particular list. And these pretty much go in order. I have listed these accounts in order. So they're going to go in the order of the date of the transaction. So you're going to be choosing which account you're going to debit and which account you're going to credit. You will always list your debits first. So for the first transaction, because of the way it's lined out, you know that the debit is going to be cash and the credit is going to be Yarwood Capital. Okay, now they should be listed out pretty much in the order which they're taken, but if not, it's fine. You still need to determine, based upon how debits and credits work in accounting, which account is debited and which account is credited. And again, the debit's going to come first, and then your credit will come after that. And so in here, you put the debit, and I'm just using an example here, $1,000 for your debit, $1,000 for your credit. So you'll see that your debits and your credits must equal. Now again, this is just an example. This is not going according to what your problem in the textbook has. So again, you're going to be listing for every transaction that occurs from July 1st through the 31st what your debit is and what your credit is. And again, the debits and credits must equal. You can have more than one debit and you can have more than one credit. However, they still must equal, the debits must equal the credits. Okay, after you're done journalizing all of your entries, the next step is to post those entries into what's called the T accounts or the ledger. So if you'll notice, we have a T account set up because they look sort of similar to a T. And in the T account, we're just going to be posting what we have done in our journal entry. So what we have posted in requirement 1, if I can get there, some reason it's not allowing me to get there. Anyway, I'm sorry. So in requirement 2, we just go back to our journal entries, and we had a debit of cash for 1,000. So we just type in 1,000, and then we had a credit to capital for 1,000. We just put that in the credit side for the capital account. Now I just noticed that I did not change the name of the capital or withdrawal account. Don't let that throw you. The textbook changed this, and I had to go in and revise these, so I didn't change that name. So it is Yarwood capital and Yarwood withdrawals. We'll adjust that for the next class. So all you're doing is taking the journal entries that you did in requirement 1 and transferring them to the T accounts. So you got to be very careful that you don't make a mistake. So if you had a debit in cash like we did for $1,000, you come over to this T account and you list it as $1,000 on the debit side. For the capital account, we had a credit to capital, so we come over to the credit side for that date and list 1,000. Now, when you're done transferring all the amounts from requirement 1, the journal entries, to these T accounts, what you're going to do is balance them out. So you're going to add up all of your debits, and you're going to add up all of your credits, and you're going to subtract the larger from the smaller from the larger, and you're going to either have a debit or a credit balance. So after you're done posting all of the entries, you'll have, for each of these accounts, you're going to have either a debit balance or a credit balance. Now let's say that was the only transaction for cash. We would have a $1,000 debit balance in the cash account. Once we're done completing and transferring all the amounts from the journal entries over to the T accounts, we then take the final balances that are in the T accounts and we go to requirement 3 and we simply list them. So all you're doing is copying the balance that you had in each of those accounts and moving them over to what's called the trial balance, which is basically just a balance to see whether do your debits equal your credits. Because remember, we have to have, for every transaction, debits must equal credits. So at the end, our debits must equal our credits. So what you would do is you would come over and we had $1,000 in cash, a debit balance. So you list $1,000. And you do the same for every single account, whether it be a debit balance or whether it be a credit balance. And in the end, you total them up. You add those columns up, and again, your debits must equal your credits. So in this case, let's say we just had that one transaction. We had a $1,000 capital credit balance. So at the end, we would have 1,000 debit balance and a 1,000 credit balance. Okay? And that is our trial balance. So this is the means by which we determine, did we do all of our journal entries correct? If you add up your debits and then you add up your credits and they do not equal each other, you want to go back and make sure that you transferred the amounts from the T accounts correctly, that you added these up correctly and came up with the correct balances, and then that you transferred the amounts from requirement 1 to requirement 2 accurately. And that's all there is for problem 229. Now for CP 241, the first 3 requirements first 4 requirements are the same as what we did in the other problem. We're going to be listing all of our journal entries here from December 2nd down through December 30th. Then we're going to be taking those journal entries and transferring them over to the T accounts, just like we did in the first problem. And then we're going to create a trial balance, just like we did in the first problem, by transferring the amounts from the T accounts to this trial balance and making sure that at the end, the debits equal the credits. Now we're going to go a few steps further, because from this trial balance, we can actually create the financial statements. So from this trial balance, everything that we have here is going to be transferred to a particular financial statement that we're using. The financial statements are the income statement, the statement of owner's equity, and the balance sheet. Okay, so once we have those amounts in there, then all we're going to do from the trial balance is we're going to be transferring them over to our income statement. Our income statement begins with our revenue, so you're going to put in the revenue amount, and then our expenses. Now, if you notice, I have the different accounts again listed here. So all your accounts are going to come from these available accounts at the bottom. But I want you to make sure that you type those accounts in. Don't just put the amounts. You need to list out what those accounts are. For instance, this would be service revenue, and then your two expense accounts would be rent expense and utility expense, and then your amounts would go here. You would add up your total expenses, and your net income would be revenue, your revenue less your expenses. So you would subtract your expenses from your revenue to come up with your net income. The next statement is the statement of owner's equity. Now, what's important here is that the net income is going to flow over to the statement of owner's equity. So in the statement of owner's equity, you're going to start with the capital balance from December 1, 2016, which is the same as the ending balance from November 30th, 2016. Now, if this is a new business, it would be zero. If it's an existing business, you take the capital from the previous month. Then you would list any owner contributions that the owner contributed to the business. You would then put your net income for the month, and you would have a total. After that, you subtract any withdrawals of capital that the owner made from the business. And then you would have, at the end of December, the ending capital for Daniels Consulting. Now, this ending capital is going to come over to our next financial statement, the balance sheet. Now, in this balance sheet, what we're going to be doing is just listing out our assets, our liabilities, and our owner's equity. So you just take the amounts from the trial balance and you list all your different asset accounts. Then you're going to be listing all your liability accounts. You're going to add up your assets. Then you're going to add up your liabilities. Then from the previous statement that we just created, you take your ending capital, and that's the amount that you put in there. Now, here you're going to add up your total liabilities and your owner's equity. So you're going to take this amount, total liabilities, plus your equity amount, and you're going to come up with your total liabilities and owner's equity. This must equal your liabilities, and your owner's equity has to equal your asset amount. So if these do not equal each other, the assets and the total liabilities and owner's equity, then you've made an error and you need to go back and find out where that error might have been made. And then the final requirement is to do a debt ratio. And in order to calculate this, all you have to do is take your total liabilities and divide that by your total assets. So you go back and you take a look, what was the dollar amount of total liabilities? Divide that by the total amount of assets, and you get that from looking at your balance sheet. Okay, I hope that I have explained everything correctly and have not forgotten anything. And if you have any questions, you can always contact me at 602-639-7378. Thanks so much and good luck.